Vega Decay. So when you think about decay, and you think about options decaying, and you think about prices decaying, you think about extrinsic value decaying, normally what we're referring to is theta decay, right? Normally what we are referring to is the extrinsic value drain on the options, right? Positive theta, selling options, letting time work for me. Like that's how we usually think about decay. But with any of the Greeks, it doesn't have to just be theta. It could be delta. It could be vega, which is what we're going to talk about here today. It could even be gamma. It could be rho if you really want to, go that route and take a look at some interest rate differentials. It could be whatever Greek you might be looking at. They're all going to change. They're all going to be dynamic. They're all going to be fluid. So it doesn't mean that they're going to decay per se. But when you think about the changes in Greeks over time, it's very helpful to remember that none of these things are static. It's very helpful to remember that all of these things do indeed change over time. So whether it's a theta, a delta, a vega, or whatever you might be looking at. So I want to focus on what TP said and suggested inside of a given expiration cycle and how Vega itself changes. So let's go ahead and go into the slide here, Ryan. So decreased sensitivity. So when it comes to Vega, it's well known that longer term options have greater Vega than shorter term options. I think most of us understand that. I think most of us have, certainly been acquainted with that idea when we've looked at Vega. We're trading calendar spreads. We're looking at diagonal spreads, whatever. But this relationship also holds true for the same position as it approaches expiration. So that's kind of what I want to focus in on here today. And we'll take a look at a real live example here in a couple of minutes. If I enter a trade with 45 days to go, which is our typical entry point. This is typically where we like to, build new positions and look for new opportunities and basically enter just your ho-hum run-of-the-mill trade. I get into a trade at 45 days to go. That's going to have a relatively high Vega relative to shorter times to expiration, to fewer days to expiration cycles, right? So when I look at 45 days to go relative to 35 days to go, the 45 day to go cycle is going to be higher Vega. Right. And I think that this is going to make sense to most people because when you look at a calendar spread or a diagonal spread, you have front month, back month. This is what you do all the time, right? Like you sell usually the lower Vega and buy the higher Vega, generally speaking, with those strategies. Well, when you're looking at it that way, it makes sense. But the point that I want to make right now is that 45 days to go option. It's 45 days to go now, but it's going to evolve into a 35 days to go option sooner or later. Right? I'm going to say in approximately 10 days, it's going to be a 35 days to go option. So it's really helpful. And this is what really kind of surprised me on Monday morning, because I'm like, I've never really thought about it that way. I've never really thought about, Vega and the sensitivity to volatility within a given cycle in this way or in this regard. The 45 days to go is going to be 35 days to go. And as that happens, ceteris paribus, all other things being equal, the Vega itself is going to be decreasing. The Vega itself is going to be dropping off. And so 35 days to go then becomes 25 days to go. And now the Vega itself is even lower. Now, again, this is ceteris paribus. This is all other things being equal. The stock's moving around. All these other things are changing. The implied volatility itself is changing. The delta itself is changing. So it's obviously, a huge pot of jambalaya with a lot of different ingredients. But if we just focus in on this one little ingredient, if we just focus in on this tiny little pinch of cayenne pepper, because you don't want more than a pinch, this will really help to highlight and really illustrate how Vega operates and moves and how it changes your position, right? And when it comes to the sensitivity to volatility, so why is all of this important? You might be thinking, all right, Jim, this is sort of interesting. I've never thought about it this way, but why does this matter to me? Right? Like, why should I care about this whole idea of Vega? Well, that's kind of in the green box down below. And by kind of in, I mean, it's in the green box, as clear as I could possibly put it. The closer to expiration that you hold a short premium trade, the less you'll be compensated if volatility does indeed contract. Now, again, let's step back a little bit and let's think about this for a minute. If I sell premium, what am I banking on? Well, I'm banking on a number of different things, right? Higher probability, positive theta, right? I'm banking on, the risk return relationship, effectively, tilting the odds in my favor. I'm willing to risk 2 to make 1 or risk 2.5 to make 1 or whatever. I'm signing up for all of those things. What am I also signing up for? I'm signing up for volatility contraction. And by signing up for in this context, I mean, that's what you want to have happen. You don't know it's going to happen. There's no guarantee that it's going to happen. But obviously, I mean, the volatility contracts 80 to 85% of the time. So it's a pretty reasonable bet that at some point over the life of that trade, volatility is going to contract at some point. Well, at a certain point, if your Vega really drops off from 45 days to go to, 10 days to go or 15 days to go or 20 days to go or whatever, that is quite literally telling you that the sensitivity to volatility changes of that position is less and less and less than it was when you had the trade on to begin with. Now, why is that important? Well, again, if I'm positioning myself to be successful if volatility contracts, I want to take, the greatest amount of advantage if volatility does indeed contract. And so when is that going to happen? It's going to happen when Vega is at its maximum point for that specific position. Well, in a given position, where is Vega at its maximum point if we're just looking at the time dimension? It's going to be with the most amount of time left. 45 days to go, 47 days to go, 41 days to go, whatever. Right, so obviously, the best case scenario is you put the trade on, volatility contracts, you take it off quickly for an easy winner, of course, but it doesn't usually work that way. And so when I think about, how I translate this information into a tradable, actionable, strategy or adjustment strategy, it's just another point for what? For managing early. It's just another point for what? For getting into your trades around 45 days to go and then getting out of your trades around 21 days to go. Now, maybe for you, that's 17 days to go. That's fine. Maybe for you, that's 25 days to go. That's fine. Right? It's really more of a reference point than anything. Right? And so when you start to think about the sensitivity of volatility and how Vega changes in the over the life of a given position, I don't know, guys. I think it's kind of interesting. And I also have to say one final thing before we get into the platform and I show you guys an example of this. I don't know, guys. This is another strike against zero DTE options. I don't know, guys. Correct me if I'm wrong, but in a zero DTE world, you basically have no sensitivity to volatility contraction. It's really not going to help you at all, right? Not relative to what it would do if it was 45 days to go or 37 days to go or whatever. And so it's like, man, I don't know. I mean, I'm still going to do some, right? I mean, we obviously got out by the skin of our teeth on that SPX guy last week. I'm still going to do a few, but I'm not really sold on the whole idea. I've been very open and honest about that. But Ryan, go ahead and bring us back into the platform here. So let me show you guys an example of this really quick. So if I go into my my portfolio here, market's about the same, still NASDAQ down about $1.30, Dow Boomer Index down $1.40, and so so if we go into TLT, so if I look at TLT, I'm just gonna keep this really, really simple. Let me go into May. Let's go into the May 19th cycle with 52 days to go. Hey, May 19th, that's a good day, right? That's a very, very good day. Optimized what? Hold on a second. Yeah, I don't want that. So if I go into May with 52 days to go. So if I look at the 100 put, I can do this for any strike, right? But I want to look at the 100. Let's try to create a ceteris paribus situation to the best of our ability. Right? Let's try to create an all things being equal scenario, to the best of our ability. So let's do the 100 strike. And let's look at varying expirations getting closer and closer to expiration. And again, choosing the 100 strike, I think it'll probably be readily available in all the different cycles that we might look at. So if I look at the 100 strike in May, you can see the Vega on this is 13. Right? You can see that right over there on the right-hand side. So my Vega is 13. Let me clear away my drawings. Let's go a bit closer. Let's go now to April. Well, let's go to May 5th. So if I open up the May 5th cycle, you look at the 100 put, which is now way up here. My Vega is only 11. So you can see it happening, right? You can see the Vega dropping off. Now, again, this might be something that you look at often when you do calendars or diagonals or whatever. But keep in mind that all the positions you have on now are going to hit all these checkpoints. Right? They're going to hit all of these way stations on their way to expiration. Yes, you might manage early. Yes, you might take it off. Yes, you might do all these different things. But if you just leave it on, right, which I mean, all of our trades are going to be on for some amount of time, it's helpful to understand that the Vega is going to be decreasing slowly over time. So we see it right here going from the May 19th monthly to the May 5th weekly. We see the Vega has dropped by 2 points. So if I now minimize the May 5th weekly, if I go into like April 21st, so this is going to be the April monthly. Let's look at the 100 strike. You see my Vega is now 7. All right, so now it's fallen even more. So it appears that there's a non-linearity to the Vega dropping off as we get closer and closer to expiration. It's decelerating at a quicker pace. Like it's actually dropping off the table more quickly. And so the 100 strike in the April cycle is a 7 Vega. If I minimize that, if I go to the April 6 weekly, so it's only 9 days away. If I take a look at the 100 strike, that has a Vega of only 3. So now we're basically at nil. We're basically at 0 when it comes to the Vega and the volatility exposure. And then for my 0 DTE crowd, let's go into, well, for TLT, we can't do 0 DTE, but I can give you a 3. I can give you a 3 DTE. So there you go, man. The 100 put has a Vega of 1, right? The 100 put has a Vega of 1. And this is still 3 days to go. So obviously, I mean, I want to get into the questions, so I don't want to spend too much more time on this. But if we went in SPY or SPX or whatever, QQQ with the daily options, those the 0 DTE crowd, take a look at some of those Vegas. You're going to see that they're not even there. They're non-existent, right? You can choose the at the money option. In fact, I got to know now. I mean, I can't leave myself hanging. Let me go into, let's go into SPY. I go to the trade page. Boom, 0 D. Well, this is not really fair because we're really close to the close because of the time of my show. And so that's why whenever I'm doing 0 DTE, they're technically going to be 1 DTE because I do like to do most of my trading live on the show. I think it gives you guys a different experience that you can't find really anywhere else. And so I really want to maintain that. I'm very, very hesitant to give that up. But if I look at a 1 DTE, SPY, wow, look at this. Now the Vegas are actually interesting. Very interesting. Huh. So if I look at a 390 put, the Vega is 9. So that's got to be a product of the fact that we're dealing with a $400 stock as opposed to TLT only being a $100 stock. All right. So the 390 put has a Vega of 9. I want to look, and this is only a 1. This is basically your 0 DT option. So apparently it's more contingent upon the basis of the underlying, at least. There may be some other things that I'm missing too here in the moment, live on the program. Another thing that you can't find anywhere else is me being a total bonehead here on the show. So let's look at a 390 put. Now I'm really curious though. We have to follow this rabbit forward through the forest here. Let me look at, what was that, 390 strike? So let's look at the 390 strike in April. Okay. So at least I know a little something. So the 390 strike in April has a Vega of 40. So I think it's all, and this makes sense now, right? I think it's all coming back to me now. Celine Dion style, like we got it. The basis of the stock is a big driver here. You have a $100 stock with TLT. You have a nearly $400 stock with SPY. TLT had Vegas of 1, 2, 3. Well, that's like having a Vega of 369 or 12, 40 when it comes to a $400 stock. And so I think that's a big difference here. So if I go into the May cycle, this May Vega is going to be like infinitely large. Yeah. So the May Vegas almost 60. And so that makes sense. That makes me feel a little bit better. I'm like, wait a minute, like what's going on here? But I think we got it. I think we finally figured it out.